All right, Keir, can you hear me now?
Yeah,
Sure
you're good. We
can.
can hear you.
Sorry about that, guys. Sorry, technical difficulties on this end.
All
Um,
good.
yeah, so Keir, heard your question, and take it back a little bit. When I joined Happy Belly, we were, at the time about a $1 million business. There was one CPG asset in the business called Holy Crap, and there was another one in the business called Yam Chops. Today, combined those two at the time, about $1 million in business. Today, that business exists of Holy Crap and of the OG assets. Holy Crap, let's say, does $1 million a year, and the other incredibly good money losing asset named Yam Chops is no longer. So today, we're approaching 80 stores open across Canada, and just Canada on the restaurant side, and we have two CPG assets. One is the Holy Crap asset today, which has grown and is profitable and debt free, which it was not when I joined. And the other one is called Lettuce Love, which is a popcorn brand that started off quite small, say $100,000 in business, and today is probably 350 on its way to say $500,000 a year in business. So, and it's profitable, debt free, cash flow positive. So, good businesses on the underlying piece, but the core business QSR, about 80 restaurants in operation, and I think currently we have another 14 under construction as we speak. So, I don't know if that answers your question, Pierre, but sort of giving you a high level.
Yeah, for sure. So maybe you could just run us through all the different brands that you've got that sort of make up that approximately 80. You've got, I know Heel has, you've been making lots of news, opening lots of these guys. Maybe you could sort of run through some of the portfolio in terms of the
Yeah,
separate brands.
sure. Yeah, sort of a cadence of how it went. Back then, Heel was the first one we brought in at the time. First deal we did, we did a JV deal with that deal. In that, when I say that is, we formed a new company. We rolled some stock into the asset in the company, and they rolled in the Heel ownership, and we became 50-50 partners. So there was two stores when we joined, basically and I'm going to say a pretty flat level P&L, basically up and down a little bit here and there. Quickly have grown that asset today to 28 stores in operation. Number 29 is going to open this week in PEI. And then right behind that will be number 30, which will be Toronto Eaton Center. And from that standpoint, not a 15x in store growth, but a business that was on a run rate of, I think it was about 1.4, 1.5 million when we did the deal. I have to go back and look at that. Today it's probably, it's approaching 30 million. Very, very cash flow positive, and on its way to seeing significant double-digit growth again in 2026. So it's that was the first one. If you look at, then we've done a few after that. We did a 100% acquisition when we acquired Lettuce Love. We did another JV deal on the way. Second one in was Rosie's, and then we did one with Pyro. And Pyro was in first, then it was Rosie's. Pyro is a clean eating Mediterranean diet based brand out of Ottawa. 4 locations currently. Then if you look at Rosie's, today, in my opinion, the leading smash burger brand in Canada. There's 10 open. There was 2 open when we met Dustin and Daniel. They were working on a third. And that brand next year, likely going to be in 26, somewhere between 20 and 30 stores open. So it's definitely hit its inflection point. Post that, we did a deal for Via Chibo, an asset that my partners and I originally owned. We vended that in. That asset has grown as well since we've acquired it and experienced positive same store sales. So great one. We created then a Joey Turks, which is a QSR, so that's fast casual, small version of Caribbean food, island fare, basically where it plays. Then we did a deal for IQ Foods, a brand out of Toronto. We've basically now, since we've acquired it, we've doubled the footprint. Double, clean eating. Direct competitor to that one in the United States would be Sweet Greens. Difference between us and Sweet Greens: we own some of the stores. Some of them were franchised, where they're predominantly all corporate. We're profitable and debt free, and I think last quarter they lost 35 million. So we're not in the same league as them in top line, and nor are we in the same league as them in bottom line. They're very good at losing money, and we prefer to make money. So a little different. Then we went in and played, working in a category which we call the younger gen cooler beverage brand that we're trying to grow, which is Small Tiger, and trying to play in a similar kind of era that Dutch Brothers plays. So that's next in motion. So the first one, which is a consolidation of a sector play, which is the last one we've done. We did one called Salus. So Salus is a clean, healthy eating bowl concept, just like IQ Foods, just smaller footprint, much lower AUVs, but has plans to consolidate and integrate over time with IQ Foods. So I think that sort of gives a little bit of an overview, Keir.
Yeah, and that's sort of great color. Obviously, we've seen a lot of heels sort of ramp up, and there's also been some mention of like trying to take some brands and put them into like co-location. I guess the example would be like Wendy's and Tim Hortons. There was a famous sort of partnership a while back where they kind of we're both kind of selling to the same customer, so why not put them in the same location? Are you guys doing any of that sort of stuff with Happy Belly brands?
Yeah, you know what? We've done a few now. So the first one that we experienced it with was actually in Burlington. We had a Lettuce Love and what at the time was called Pure Love, which was the smoothie concept on the side. So they were sharing a space with a kind of a half wall down the middle, but crossover and some cross functionality within the space from staff and service model. So we switched. That one was our first test. We put in a heel and experienced a significant lift in sales and profitability. So that was the very first test we did as what we call a shared space model, or call them a co-branded space. That was the first one. Then once we were happy with that model, we did another one. We've done two more since then: Lettuce Love and Heel. One is in Bloor West in Toronto, Bloor and Runnymede area, and then another one we did at McMaster University in Hamilton called Westdale. Those are shared space models with those two models. Then we did another one recently at Shops at Don Mills in Toronto. We did an IQ Foods and a Heel, very similar model to Lettuce Love and Heel the way it was done. Shared back of house, but separated front house. And that was I'm going to say that one opened up about 4 months ago. And then since then, we've signed one more where we were doing that. That is a kind of Queen and Dovercourt, Queen and Ossington area of Toronto. That is started construction in January. So now we'll be up to 5-6 locations where we've tested, basically trying to drive sales per square foot, and drive frequency and customer traffic in the stores with a co-branded space. So we've got a couple that we've done, and we're still doing crawl, walk, run with it. We're very happy with the numbers so far, but for us to continue increasing it, we just need to see continued improvement on return on invested capital, which is something that we're very focused on. But yes, co-branding is something we do. Are looking at other locations with Small Tiger and IQ. We're looking at different combinations. Usually, the decision is driven by the location, the demographics, the co-tenancy, that kind of stuff. So yes, there's opportunity for it. We believe it is a big part of the future. Rents are not going down anywhere, so you need to continue to drive more sales per square foot, and so smaller spaces or more brands in one space to hit the magic numbers on rent. So that's a big part of what we do.
Great, thanks for answering that. There's obviously been recently some discussion about maybe some of the brands, like a few years ago, Puro was kind of, excuse me, was sorry, Puro was kind of, all the talk of the brand. There was a big discussion about it. There was Cava, which was going through an IPO in the US. It seems to be a little bit sort of stalled in terms of like new development. Is there any sort of cause for concern on some of these, or is it just you're just sort of focused on unit economics and the quickest ones to sort of get open?
Yeah, there's so many factors to go into which brands grow, but if you understand the philosophy that I have and the company has, it's imagine every day you have $1 to spend, and you have to grow your business off that $1. So what you got to focus on is where do I going to spend it today to give me the highest rate of return? So, or reference that as highest return on invested capital. So it's not like you have just unlimited money and you throw it at all of them and give everybody 10 cents because you got 10 brands. That would make 0 cents, right? And it would put, if, especially if one brand delivers you a 2% return and one delivers you a 50% return, well, then you're going to allocate more of your capital to whatever brand is delivering the higher rate of return that day. Can that change over time? Yes. And the good news is for shareholders, when we have a diversified portfolio, we're not all counting on one, right? Just to hit our numbers or growth. If you want to deliver 30 stores a year, it's a lot easier to deliver on average 3 stores a year across 10 brands than it is for one brand to deliver 30 stores on its own. So sometimes the customer dictates it. Sometimes of what the sales are, what the performance of the brand is, which one we grow and where we allocate capital. So you know, as much as I'd love to say all of them grow the same, I love all my kids the same. Everybody, like every parent has to answer the politically correct answer. Well, if one kid comes home and gets, I'm going to say straight A's, he gets more money than report card time than the kid that got straight D's. It just is. It's just the reality of the business. I allocate capital based on performance of the brands. So some of the brands are performing better than others, and some of them it's just a franchise business, right? So they're franchise driven. But if there's not as much franchisee interest, even though the numbers are great and the brand's great, I can't control that. So franchisee interest is certainly sometimes a key driver. And certain brands like Heel, like Rosie's, today dominate the. You look at franchise, applications for say a Heel to a Pyro. Uh, I don't know if it's probably 50 to 1 for every application that come in for Heel that come in for one Pyro.
Right. And I would
Hmm.
imagine it's a little bit simpler to get them set up. A heel, you don't require a cooktop, you don't require sort of the same venting. I would imagine that the franchise cost of getting one established would be quite a bit lower than a restaurant
Yes.
that's having
Yeah, the
a
skill
quick
set of the
protein.
yeah the skill set of the franchisee is different, right? It's like saying, well, I want to open a keg. Well, there's only so many people in the country that are qualified to open a keg. But Heel, to your point, there's no ventilation, nothing. So Heel has an advantage from a real estate perspective, smaller, more unique, and fit in 500 square feet. And it also requires no venting, no nothing, and it also requires a different skill set to operate. So, and Heel today, if you look at it from an employment standpoint, it's like working in a Starbucks. So every kid that grows up says, "Oh, I'd love to work in a Starbucks," or "I'd love to work in that kind of like a lot of girls. I want to work at Lululemon." Well, Heel's a lifestyle brand, so a lot of people love working there. Every young girl that lives, high school or university or anything that's around it, they all want to work at Heel.
Well, and I've noticed that they do seem to do quite a bit of community kind of initiative. There's kind of a run club and there's merch and things like that. And so, in terms of heel lifestyle, maybe you could explain for some of us that haven't had a chance to get to go to one. What's heel all about? What does it sell, and where does it kind of
Yeah,
fit in?
yeah. What's the driver behind Heel is, some places you say, "Oh, I might go once a month, or I might go once a year, twice a quarter," right? Like, I was very surprised to see talking to some guys from Crumble Cookies recently, and they said the average consumer goes to Crumble twice a year. which is their core customer, twice a year. That's kind of crazy, actually, when you think about it. But a heel, some people go twice a week because it's part of their diet. It's part of their routine. It's a functional item in their health and their wellness. And if you look at how many people today that walk into a heel that are wearing Lululemon or some sort of active lifestyle clothing, it's more than half the customers. So it's fit into a very unique category and gets high frequency of customer traffic because it is part of your regular routine and regular diet. I go to heel, well, minimum 2, 3 times a week, and so do a lot of other people. It's not just me. It's become very much lifestyle brand. It's literally part of your lifestyle. And when it first started, it was much more younger, but now because I think a lot of people didn't even know what an acai bowl was. But as people are, so when I define that today, I was in institutional meetings all day today, and what I define that is an emerging category, sorry, an emerging brand in an emerging category. That's the definition of where you get crazy compound growth. Because it's not just a brand that's in like a, emerging brand in a mature category. You're going to grow, but you're not going to grow at crazy exponential numbers. But if you find an emerging brand in an emerging category, well, then you got, you know, potential unicorn. And that's what's happening. So the consumer base is growing. So that's where your same store sales comes from. And then the category is growing, which is where the unit count growth comes from. And we're experiencing both on that with that brand.
Excellent. So I would imagine some people might have, like me, as you're growing the number of locations, the number of brands, the number of franchisees. What's sort of needed by Happy Valley Parent Co. In order to continue to scale? There's only so much Sean Black that can like get on a plane and go around. We watch your travels, and I wonder when you sleep. But I would imagine you've got a bit of a extended team kind of behind the scenes. What's kind of the most critical kind of roles, and where are you at in terms of, are you comfortable in terms of capacity? Do you feel like you have any bottlenecks for continued scaling, or are you just getting into your groove?
Yeah, well, yeah, part of it is, uh, what you see today, like, once the store is open, to get that store open, a lot of stuff had to happen. Probably, 3 to 12 months in advance, you had to find the spot. Then once you find it, you can negotiate the lease. Then once you have the lease, you deal with the budgeting and the planning. You design it, then you do the budgeting and the tendering, and then you get into construction, usually 30 to 90 days in advance, and then you have to open. So, but to get in between there's training of the franchisee, there's legal, there's ops, there's so many pieces that are like moving parts. And to get to all this stuff, very transparently, like as we're scaling up, are we adding people? Yes. The one thing I tried to do as a team is we don't overhire just so we don't have to work very hard and, get there. We wanted to get there as lean as possible. So every shareholder dollar that we spend, it's very much, well spent versus hiring in advance. Nobody has to work hard. And then, you know, shocked if all of a sudden you actually have to, show up one day. So the good news is all of our team is very functional. But are we going to have to add to them? Yes. We've approved, I've approved, like looking at budgets and stuff. Once we look at a budget, we start to forecast what's coming in Q1 or Q2. As the revenue's coming online and more of these stores are opening, are we going to have to add a few people? Yes. We've added a few people in the last 30, 60 days. Yes. And will we add more in Q1, Q2? Yes. We'll be adding more because we can't open another 10, 20, 50 restaurants and not any staff. Like it's impossible. Right from back of house, from accounting to legal to ops. Because it's one thing to open them, but then it's also the next piece of the business, which is keeping them open and keeping them profitable. So we need a really good team to execute at a high level. And, are we, for the most part, are we there? Yes. We're probably 80% staffed up for what we need to do. There's probably 20% of our staffing and headcount that we'll need to add over the next 3 to 6 months.
We always read about it. Hey, a store opened. Hey, we've got a financial commitment for 20 locations. Hey, we're gonna break a record and open more locations next quarter than we did previous quarter. There's a lot of work that goes into actually, like you indicated, in order to go from somebody who might be interested to getting an operating restaurant location. One of those would be construction, the contractors. That's a real part of the business. With you guys, operating in multiple, excuse me, in multiple provinces. Excuse me, with you guys operating in multiple provinces, how do you like? Do you have like preferred contractors? Do you have groups that you've worked with before? How do you make sure that you guys are getting a good job done and that it will open sort of on time? That's a question
Yeah,
from the audience, by the way.
that's a very good it's a very good question. Part of that is it's actually all the above. So twofold. Our process is, like today, working on a new deal today. Site comes in. I send the info over to David LeBlanc on our team, who's our VP of Design and Construction. Incredible person, hire, working way above his, probably his capacity level of what he should be doing today. But we send it over to David. David, gets it site measured, site spec'd. Then he goes, once he has that, he does the baseline drawings. Once he's done the baseline drawings, he then turns it over to the ops team. Ops team lays out the restaurant inside the four walls, gets it all laid out the way they want. Perfect. Send it off to the engineers, architects. Um, Once that's all done, then the full set of drawings are done, everything's ready. Then we send it out for tendering. And that process today is, running very well. We've got a great group of vendors. And then what we do is in a market, depending on the type of market, we send it out for a tender and there'll be anywhere from 2 to 6 contractors for the whole job. Sometimes it's parts of the job, but we have preferred vendors in every market. And depending on their availability, their capacity at the time, all those things, like there's no such thing as the flat price. Like nobody gives you a flat price when the restaurant change every time. So you actually have to bid every job out. And in every market, there is, we have availability. Probably the hardest market recently I tried to get a contractor in was PEI. Halifax is booming, so all the contractors are between downtown Charlottetown and Halifax and stuff like that. The market is on fire out there, so it's actually much harder in Halifax and Atlantic Canada to get a contractor. And you used to joke and say, "Well, they're all out fishing and on the fishing boats." No, now it's not true anymore. They're not fishing like they used to be. At one point in time, you went to Newfoundland, you tried to get guys. They're all working on the oil patch in Alberta. They were making so much money, and now these areas are experiencing post-COVID. They're experiencing like major booms in population growth and residential. And you look downtown Halifax, downtown Charlottetown. There's apartment buildings, condo buildings, just office, everything getting built in these markets. So for skilled trades, man, there's a shortage out there. We actually, believe it or not, when we tendered out one of the jobs out there, the cheapest price we got was sending out our crew that does all of our jobs here in Ontario, not all of them, but a lot of them, out to Atlantic Canada, put them in a hotel for 30 to 60 days. The whole crew was still cheaper than hiring somebody from Atlantic Canada. So, anyways, but that is part of the process. And one of the next key hires that we're going to make is on David's team to handle the tendering, the budgets, the tendering, the permitting. So design and construction in Q1 will be adding somebody to that department because we need to up their capacity to be able to handle what's coming in 2026.
And there's been lots of discussion about this term financially committed. Going out and doing a deal with like an area developer who might commit to opening and managing sort of 10 to 30 sort of franchise locations in any area. And there's some term financially committed. Are you able to kind of just explain to the audience kind of what that really means and what period of time they typically would have to get these operational?
Yeah, depending on the agreements, most of them are done, say, over a 10-year period. So they commit to 10 stores, example, they have to do one a year for 10 years. Now, they do lose the agreement expires after 10. So they are, and all the agreements are only 10 years in length. So they are heavily incented to, front load that agreement because, they increase their income during that time. So the area developer has 2 options. they can open the stores themselves, or they can uh, sell into their territory. And what they do is then they participate in the royalties of that territory. But they're motivated to develop one way or the other, open themselves or sub franchise is basically what they do in the market. Now, some guys have come in and buy exclusivity, like the group in Texas, the first group. The first 10 they're doing, they're opening and operating them all. They're not looking to sub franchise, they're not looking to do anything. They're a direct development deal. So they're an area developer, but they're buying and operating them all. And then some area developers, Scott, Steve Travers, David out east, those guys are sub franchising. So they're actually like development agents, and they're contractually committed to open those stores, open them or sell them. And if they don't do one of those two, then it comes back to us. If they don't meet their development goals that they're contractually committed to, we have the right to terminate their agreement and take back their territory.
And in for these area developers and some of the franchisors or sorry franchisees that that taken on these stores and operating them, some of these people are known to you. You've already done business with them previously. They've already operated brands for you previously with your experience kind of in the industry. Is that fair to say? Could you maybe provide a bit of color that some of these people that you're doing business with, they're not just walking off the street and saying, "Hey, sounds good. I'd love to open a restaurant. Never done it before." But these are people that have experience that you've done
That's right.
business with.
Yeah,
Prior.
very few of our stores to date have went to first-time franchisees. A couple, but very few. Most of them have, especially all the early deals, they came from somebody I knew from franchising in Mucho Burrito, Extreme Pita, might have worked for us at Burgers Priest, might have worked for us at Fresh. So within our existing network, but then, so there's my network and our team from my previous brands here, but then there's also Steve Travers. Like I've opened hundreds and hundreds of restaurants, and so Steve in Western Canada, right? So Steve Travers also has his own network. Steve also has the rights to Alberta for Osmos. He also previously was on the development side for Stacked in Alberta, as an example, right? So Steve has a very extensive franchise network that he's able to tap into. Scott has been in, he developed Stacked in Ontario. He's developed, doesn't matter, he's been with Recipes, several other brands where he has worked with me for Extreme Pita, Mucho Burrito. So he also has an extensive network. So it's not just one Rolodex, it's across the country. David did development for Orange Theory, Quiznos early in the day in its peak. Like David's been on that side too. So David also has a very extensive network. When we were bringing Rosie's out there, David knew exactly who to call. Calls up Wade. Wade's a multi-unit franchisee in the East for Smokes Putin. Says, "Hey, David," or David says, "Hey, I'm bringing something out." Comes, tries it, does the belly check. Next thing we're off to the races, and we got a multi-unit franchisee for the territory. So we're very fortunate that the majority today of our franchisees are all multi-unit and have prior QSR experience. The gentleman who came from Scott was one of the, he's been with A&W and, the list goes on of brands. He bought, a lot of stores from us in Ontario for Let Us Love, Heal. He now operates both of our yolks in Ontario. So multi-unit operator as well, multi-branded and multi-unit.
You mentioned before something about sort of like unit economics per square foot. Would that be sort of like, what sort of like revenue a location is able to do per square foot? And are there any sort of like comparables or any target that you guys are trying to target internally eventually?
Yeah, like a lot of QSRs, if you use an example, there's say 1,000 square feet, and so if it's 1,000 square feet and you want to run a subway model, you're going to do say 400,000, right? And that is in sales. So you're doing whatever. When you talk about multiples of sales to square footage, so that's okay. But really, where you want to find a brand that starts to make really good money is when they start doing probably 700,000 out of 1,000 square feet, or 800,000 out of square feet, or if you find a brand that can do a million plus out of 1,000 square feet, those are the ones you really start paying attention to. And then if you find one that does say 1,500,000, then you know you're going to really, really pay attention. If you find one that can all of a sudden do $2 million out of 1,000 square feet, then you found, or up, then you found a potential unicorn in the business. And that's, where you really start to focus your time and attention. And so we use sales per square foot, and then we use what we call CapEx to sales. When we say CapEx, it's about how much does it cost to open the store. So let's say it costs you $100,000. Well, then you look at sales to sales CapEx. You want to say, okay, if can it do, like, a good business today in QSR does minimum 2 times sales to CapEx to sales. So it costs me $200,000 to open it. It needs to do minimum 400,000, or you don't even want to look at it. If it does cost you 200,000 to open, it does 600, so it's 3 times. Well, getting interesting. And then if you find it and it costs you 200, it does 1 million 5 times. Well, then that's really, really attractive. You know what I mean? And then anything over 5 is like single-digit percentage of the industry from sales to CapEx. You're like low single digits. So those are the ones we focus on when we look at sales per square foot, and you look at a cost of entry, which is the CapEx to sales. That's what we focus on internally inside our 4 walls. That's what we're talking about every day.
Great. And so if you look at your last sort of Q3 financials that you put out, it was based upon 75 operational restaurants, and for that quarter, you had system sales of just over 19 million. So if you annualize that, consider, not taking into account any growth, just sort of annualizing that, it looks like it's just over $1 million per location.
Yep.
What would be the average square foot of something like a Heel, which is probably your largest single brand in terms of operating locations?
Yeah, that's right. And they're on average 500 to 800 square feet.
And I would imagine they probably have a pretty low cost of CapEx as compared to something like a full service restaurant like a Yolks.
Yeah, let me give you a Pyro. Let's say they're probably 25% of the cost to open one of them versus a Pyro on average. 25 to
And
50%. So it's like half the price.
So using your metrics, a Heel, has, it looks like high revenue per square foot, small store, and then it would also have a good multiple on your CapEx, a good multiple on sales versus the CapEx to open it.
That's
So
right. Then if you look at ease of operation, it checks that box as well.
Yeah, so I would imagine that's why you've seen a lot of growth in that brand. And how does that sort of compare to Rosie's? Does Rosie also, could we assume that it sort of ranks high on those sort of key, criteria that you guys are using to assess which brands to focus on?
Yes, it is top 4 brands performance in the country, in our platform by far. Sales per square foot, it checks. Sales to CapEx, yes. Requires a little bit more of a skill set to work in there, and you got a flat top, you got a hood, and all those things. So that doesn't check the ease of operation. But when you could do better sales than let's say a Montana's out of 1,000 or 1,500 square feet, and a Montana's is operating out of 5,000 square feet, that's where it gets really attractive. If A&W costs $2 million to open, right? And on average, let's say an A&W does 2 million in sales. Well, if Rosie's can be, let's say 25 cents on the dollar to open, it's less, but let's just say it's 25 cents on the dollar. But then it can do same or more sales of an A&W. So, if it's 2 million to open an A&W and they do 2 million in sales, so that's 1-to-1 sales to CapEx. So let's just say on a worst case scenario, Rosie's was 500, and say it did 2 million in sales. You're talking 4-to-1, right? So that's in that sweet spot of 3 to 5. That's excellent.
So
yes,
we've heard
they're just
yeah.
the best P&Ls at the, that you can find. So that's what attracts capital.
Great. That's excellent. Thanks for going through that. We've heard a little bit about expansion. You've primarily been focused on the Canadian market. We have heard, last year we heard about your foray down to Florida. Maybe something was going to happen there. You've now gone and done a deal, your first kind of deal in Texas here. What do you think about expanding into a different sort of country, into the U.S.? How's that in terms of like skill set, the ability to scale? What are some of the both pros that you're excited to experience, as well as sort of the things that are potential complications about expanding into a completely new country?
Sure. You know what? Yeah, and thankfully we've been through this before. When I built the first company and we sold it to MTY, we had about 50 operational restaurants in the US. And that was, very helpful experience. Um, did I break my nose and hurt bones and stuff the first time around? Yes, 100%. It was mistakes made, learning across the board. And so taking a lot of that and always learning the business since then is what we're deploying this time. So, it's a crawl, walk, run. So we're opening up a store, testing the market, and we'd like to add more, but we're literally going to be doing them in a very, I'm going to say, reasonable cadence. Do several in a market, see how it goes, test other market, get them, get as much, collect as much information from the markets, customers, average check, the flow, what menu items, if at all, need to be tweaked and everything. And then, if you crawl and it works, then you start walking and you go a little faster. And maybe you'll do a few more stores. And then if it really works, then you start to run. And we're looking at multiple markets today. Yes, the first one we've signed physical real estate is Texas. We're looking to be open in Texas in the first half of 2026, with both Rosie's and Heel, and measure the results, and then again, where makes the most sense to allocate capital is what we'll do. And so we're very lucky. The first few deals, we don't have a big P&L risk. It's going to be more time and effort, and getting it set up. But is it happening? Yeah, it is happening. It's where it meets the best opportunities. So you got an incredibly experienced operating team down there. They're very well capitalized. So having a boots on the ground team like that is incredibly valuable, because they're currently operating in restaurants in the space already down there. They had a major influence in helping us secure the real estate, um, getting it done, local attorneys, local architects, designers, everything was able to move really quick when you have an experienced, well capitalized team that's got boots on the ground. So that's why Texas took off the quickest.
So I've got a couple of audience questions that I'm going to ask you, if that's all right.
Fire away.
First question: we hear a lot of good news from you. What's one thing or two things that isn't working as well as it could right now, and what are you doing to fix it?
Well, two things. I got one, there's only the only two real things that are honestly a pain in my ass in the whole company so far, that because they're not achieving the results I wish they would have from the get go. Are they growing and improving? Yes, and I'd say that's the first two Joey Turks. I'm very happy with the food. I'm very happy with the team, but getting the marketing right, getting dialing it all in and stuff like that. Like those are the first two that if I could, snap my fingers and make them perfect overnight, I would. But it's a brand new brand. It takes time. Most some brands can be around for 30 years before they click. We've opened a couple. We're working on the brands. We're, working to improve the sales, improve the unit economics. And that's why we haven't scaled it or added more of them, because they're not at a number yet where they're worthy of more capital. So once they're worthy of, more capital, and, then we'll open more of them. But the short term, until the P&L justifies doing more of them, we'll have two of them. We'll stay right there. Just keep executing them. And in 12 months from now, if we're not happy with the P&L, who knows? Maybe you convert them to one of our other brands, right? You use the real estate, the infrastructure, and you convert it to another brand. That's the beauty of having multiple brands. We have that option to look at different scenarios. But short term, yeah, if anybody wants to know, like, is everything perfect? No. Are we learning every day? Yes. Are we getting better every day? Even with the stuff that we're good at, are we getting better at those every day? Yes, we are. But is everything like, so they say sunshine and rainbows and it's all perfect? No. If that was the case, I wouldn't have to travel. I wouldn't have to do everything. The business would just grow on its own and be all perfect. But we're not a GIC. We're not trying to grow at 4% a year. So to deliver the results, it takes a lot higher effort. And in that comes, there's nothing's perfect in the restaurant business. It's never 100%. But you can make the Hall of Fame with a pretty good batting average.
Well, great. Thanks for answering that. I've got another audience question. What's the biggest challenge that faces Canadian food brands today?
That's a good question. There's a couple of them. I'm going to say, labor is always one of them, right? Like depending where you're at, getting good people. I'd say that's always a challenge. So your brand, people got to want to work for you and want to work with you. Um, that's part of it. We're seeing what we call a dine down in the category. So I'm seeing a lot of people that might have been out on a Tuesday or Wednesday night and might have went to the keg. I am seeing them all of a sudden, showing up at a fast casual or QSR. So I think if you see some of the brands like an A&W or Rosie, stuff like that, they're probably getting more of the occasions that people go out for dinner or so that I think that is happening. So I think some of the consumers are dining down. Prices have gone up. You know what I mean? And especially to go to something. I use the keg as an example. Obviously, it's an easy one, but portion sizes have gone down and prices have gone up. Real simple, right? In a lot of those categories, and it's not getting any cheaper. So I think that's part of it. Dine downs out there. So I think consumer spending. I think there's a shift, and I think more of it's going to QSR and fast casual, just like it did in 2010, and just like it did in 2000. So I think there's a real rotation on brands, people, and then the other thing is staying relevant. So many brands out there today that are older and whatever, like they're having a really tough time, staying relevant. You look at the mess recently that Cracker Barrel had in the United States, tried to change their logo and do a few things differently. Well, holy geez, their base lost it on them, right? They they had a real problem. So staying relevant is the name of the game in this business. You gotta move, market, product, innovate your food, stay relevant in the consumer's eyes. And there's so many brands that have lost that relevancy. Subway's one of them. That don't get me wrong, they still have a lot of stores, but then Jersey Mike's comes in, or Firehouse Subs comes in, Jimmy John's comes in, and they literally like stole their lunch, right? They're Jersey Mike's got a $1.2 million AUV in the stores, and then you have Subway with $400,000 AUV, right? So you want to be innovative on the on the front curve and staying ahead of the competition. So that's always a threat. There's always a threat of competition.
Has it another audience question? Has volatility in supply chain or ingredient costs materially impacted operations or any of your strategy?
Yes, absolutely. Doesn't matter. A little while ago, there was an issue with blueberries. A while ago, there was an issue with pistachios. And a while ago, there was an issue with um, oh gosh, something else like, oh well, you've had the issues with beef go up in prices. You've had the issue with chicken going up. So there's sometimes it's a price sensitivity. Sometimes it's like a supply issue. Um, a while ago there was a huge freeze in California, and then that sends certain vegetables or certain products up. So um, yes, having like good vending partners and good contracts in place is pretty critical to your business. And we're very lucky, whether it's Cisco or Coke or some of the big partners, like we've got good agreements in place, but our purchasing power is getting bigger and better. So I spend a lot of time with, doesn't matter whether it's our partners at Cisco or Coke or other, like we invest in the relationship. And That's critical. But if we experience things, absolutely. If you go a long time in the restaurant business, you say, "Oh, I've never had an issue with staff, or I've never had an issue with food supply chain, or whatever," then I think it's like somebody's lying to you. They're not telling you the truth. You have those experiences every single day. There's anybody that's
Oh, still got Sean?
Sean, you're back on mute.
Okay, there we go. Yeah, but
Yes.
anybody
Yep. Yep.
anybody that tells you that you've never experienced stuff in the business, then I believe they're either, I don't know, delusional or lying, or they work in an office and nobody tells them about the problems every day. But if you go, you get on the front lines, go in your restaurants every day, supply chain, staffing, everything, that's part of the business.
Great. Well, let's run through a little bit more on the financial side of things here. Um, so this idea of system sales, this would be sort of like the revenues that kind of go through your restaurants. Some of those would be corporate owned stores where you get to take all of that kind of revenue and stick it on your financials. And then where you have a franchise location, you guys would get sort of a royalty. Could you explain kind of maybe the difference in margin between those two and what your typical franchise, what sort of, are you getting a fee for selling a franchise? Does that go to an area rep? What
Yep.
sort of
When
percentage?
Sure.
What percentage
Every store that's
is
sold, we do charge a franchise fee. There's different percentages by area developers depending on their agreement. If we have an AD in place, then they participate in the upfront. And then on a royalty basis, the typical flat base royalty is 5% for us. If you have an area developer, they will get a small piece of that. But 5% is the royalty. So the difference in the margin is if you open a corporate store, you might operate 10, 15, 20% margins at restaurant level, but you have to take the P&L risk, right? So you are the one operating it. You have to put up the cash and you have to take the P&L risk. So if you have a good month and it makes money, you get all the money. Bad month and you don't make money, you got to cover the check. But the margins are typically higher, right? But you have to put up the money to open the restaurant and you're physically responsible to run it every single day. So on the franchising side, you don't have the same level of P&L risk and you don't have to put out the CapEx. So yes, it's lower, but it's also um, less risk, right? So and less capital intensive for franchise versus corporate. So we're trying to keep a model today where about 10% of our stores are franchised. As free cash flow increases, we continue to rotate that free cash flow into more corporate stores. So we got another Heel and another IQ coming, and we'll use cash flow from the brand to fund that as we open. So it's different. The ratios, let's say it's double. You can make 5, 6, 7% on franchising, and you can make, double that in running corporate stores. But you gotta outlay the capital and you gotta accept the P&L risk that comes with running the stores.
excellent. Thanks for sort of running through that. Are there any other sources of potential revenue? Do you guys, help in terms of providing accounting? Do you guys provide point of sale? The terminal banking, some of the ingredient sourcing and things like that. Is there further potential opportunity, or is that sort of kind of those things too small and sort of the 5% kind of includes some of that?
No, none of that's covered in the 5%. But what we do is we work with, like say a vending partner like Toast, right? So they provide the tech stack. So a store, they have our platform and all done, but then stores pay a monthly fee to access that software, and and we're linked into it from a head office level. So we do pay some fees at head office level for access and information and compiling the data and stuff like that. But typically that's the case the way it works. Um, and then, let's say accounting. Yes, they can use their own accounts and that kind of stuff, but sometimes there's certain accountants that do, full franchise platforms and franchise systems. We will give them the ability to access that accountant, especially in the first year when someone, just might be new to the accounting at restaurant level. That could be a real advantage for franchisees. So some of our stuff is mandated where they have to use our preferred vendors, and then some of it is personal preference, or they can use their own personal network.
In terms of like using Q3, what percentage of sales now would be on the QSR side, and what percentage would be on your CPG, like the brands like Holy Crap and your popcorn brand and stuff like that that are sold in grocery stores?
Oh yeah,
What sort of percentage breakdown?
way north of 90% now. I mean, let's say you're $500,000 in a quarter, as an example, comes from CPG. And if you're talking 19 million of one side, I think last quarter was 19.2. Less than 500,000 of that on a quarterly basis comes from CPG. So I think here when we first started, I think you remember like it was, I don't know, 65 or 75% of our revenue.
Right.
Yeah,
So is there it? Do you guys have any formal analyst covers that now cover Happy Belly?
we do. The first bank to come out on us was Ventum. The analyst name is Rob Goff. He's posted it. People could access it. It's public. I think his first price targets on it was 220, and I think just the other day he increased his analyst covers, increased our price target to 240. Um, it's but that's the first one to come out on us at a level. There was someone else first before Devin. Devin was doing it, but Rob's taking it to a different level, and is the senior analyst at Ventum. We certainly have lots of them
And
following us, but but Rob's the first one to publish.
maybe you could explain a little bit about how you finance the company. You guys have utilized like you've utilized convertible note structure. It's got some pros and cons. Obviously, the pro is it's convertible, so you're not necessarily having people slam your shares after the 4-month hold if you're going to give them a sweetener like a warrant. Maybe you could kind of walk through the why you chose convertible notes in order to finance the business, what it's sort of meant to you, and how are you guys in terms of your cash position today? Should we expect to see some sort of additional sort of financing here in Q1 next year?
All right, good questions, and I'll answer as much of that as I can. Um, yeah, and no, you can't be leading the witness, but yes, I'll answer as many questions as I can. The So twofold is when we were trading at about 8-10 cents, we were first getting started. I went out to the banks and said, you know what, I'd like to raise money, and they're like, Keir, you know the space enough. They start salivating, and they're like, that's great. What price would you like to raise at? I was like, well, I think, we put our money in at 20 cents, so we'd like to raise money at 20 cents. Well, it got really quiet at the table, and it was the rest of the lunch was pretty awkward. Um, and so we came up with a structure at the time. It's okay, well, we'll do around at 20 cents, and insiders will lead it. And they were like, really? Like, okay, well, that changes the game. Like, let's talk about this. So we did a convertible note. We're trading about 10, and we raised money at 20. Then we were trading the next one at about 15 cents. So what it does, and the purpose of these, when we traded at 15 cents, we did a convertible note at 30. Next time we were trading at 27, we did a convertible note at 50. And the purpose of them is to minimize dilution. So good news and bad news is you pay some interest on it, but you also significantly reduce dilution. So let's say if you're, typically in a market today, I saw a deal the other day. I think it was Vladis or somebody did something, that they raised with I don't know, let's say an 18% discount to market. They put the stock out there, and, people can, like you said, can flip it and creep a warrant, or, they just clip the warrant. Well, that happens all the time. Well, for us, we went out to very friendly shareholders, most of them within my inner circle, and raised money each time at typically 50 to 100% market when we were small, right? So then the last time we did a convertible note was at 75 cents, and the convert was we did a 50-cent round, sorry, and it converted at $1. And then we did a 50, sorry, we're trading at we did a 75-cent round. We were trading at about 47 cents, and it had a forced convert on it at $1.50. So, something that when you look at that, I could have either raised a whole bunch of money at, say, 47 cents less than 20% discount to market. So let's say you do a 40-cent financing versus doing a convertible note at 75 cents. So I think on that one, let's say you raise $1 million or $2 million bucks. Instead of issuing shares at 47 cents plus the count, so 40 cents, we issued shares at 75 cents for that 2 million. So it's dramatic. Like, it's like half the dilution. It's almost like, let's say 80, 90, 100% less dilution. So it's very attractive to shareholders that are currently holders of the stock. But what it does is, you basically pay them to wait. right? It's a term that's used in the business. So you pay them some interest along the way. If you double their money or you do really well, then you can force convert them, and they've made great money, and you reduce dilution, but you pay out some interest along the way. So that's it's different ways of doing it, but raising money with a discount to market. Even if you look at our last one, we did an equity round. We were trading at, I think, around $1.27, and we raised money at $1.50 equity above market. Um, so that's typically how we've done it. If in the short term, um, we needed money for something, whether it's M&A or something, when we look at it, sure. If we had an opportunity to take money above market from a strategic, would we take money? Sure. I don't want to be I laugh at all guys who say, no, we're never raising money again. We'll never do it again. I'll be the first one to say, temporarily, we try to take in money at these current prices. No. Um, but if the right opportunity comes up or something like that, and it's very accretive, like it would move the business forward, will we look at it? Sure. But who it comes from is also about equally important to me as what price, and the structure of the financing. So thankfully, at this point in time, we control our own destiny. We've got, I think in the fins we put out the other day, like, I don't forget what the number was, 2.8 or $2.9 million or an equivalence in cash. As you see, our cash flow from operations is climbing dramatically every quarter. So do we need to raise money this round? Nope. Will we take in strategic money if the price is right? Sure. You know what I mean? Like, am I looking to raise $100 million? No. We've just taken a little bit at a time as we needed it, and then we've deployed the capital. The key here is, what do we do with the capital when we get it? You know what I mean? If I'm buying a Ferrari with it, it's one thing. But if I'm opening assets and increasing shareholder value at incredible rates of return, that's a different story. So but to me, it's not only the price, which a lot of people focus on. For me, it's the proceeds. Like, what are you going to do with it, and who gave you the check? If it's a massive hedge fund that just wants to short you and clip the warrant, then no, I have no interest in that capital, and I wouldn't take it in. We're very, very fortunate. If you understand, you look at how the market works. Of the three strategics that we've brought in, every single one of them is in the money. So when you think about it, like, if I call them again and I need something, and all you do is make the money, do they take my phone call, or do they hang up and or put me on, do not disturb or block my phone number? Right? I'm not calling off for them duck cleaning. You know what I mean? So I'm very fortunate that most of my guys will take my phone calls when I reach out.
Um, I would imagine you're starting to get on some radar screens of some institutions with your market cap today. Are they starting to? Are you starting to get a little bit more sort of notice that are coming from the institutional sort of investor, rather than just maybe strategic
Yeah,
investors that kind of know the QSR space?
yeah. It probably started off early on. Keir, is like those in the know. You know what I mean? Would call first, and probably guys closer to us because they chat with you socially and they know what you're working on. But yes, I would say as we sort of hit the $200 million market cap, um, where this is going as far as the business as well, and started building a track record in the market. I think even announcing the other day 14 record quarters. I mean, like that. So we've got a track record of execution. We've got a track record that we've been able to monetize, as well as selling assets over the years, and the business is now with a clear trajectory in the short term to $100 million run rate on a system sales standpoint, um, with a pipeline that more and more every day, people are starting to say, well, when, not if, we start opening more restaurants. That's what's changed, right? Because our growth is becoming predictable. And when you look at, predictable growth right now, like everything I've been meeting, like, and to your point, like in the last 2 weeks, I've had in the last 90 days, I've had more meetings with institutions than I've ever had in my career. And that's including my time at MTY. So, is there, you know, is our growth catching people's attention? Yes. Once you break a dollar, you break a certain market cap, you trade some, like all those things are unlocking, including cash flow from operations. I think last quarter, I'd have to go back and check the number, but I thought it was like by 6 or 7 thousand. You know what I mean? We were off of being cash flow positive, some like true cash flow positive, including that one thing was like a $60,000 write down, so which is potentially recoverable. So, but still, the numbers are getting better, and the investor level's changing. I'll also add that the recent news of MTY has certainly added fuel to this fire of what's happening in the category. There's 3, 6, 9 months where things have just been changing, right? And that's because over time, if you look at the sector, there was Recipe in the category. Well, Fairfax bought them and basically took that out of the market. Then you have MTY, being quite challenged over the last 12, 24 months. I think it's been north of 36 months since they've done any M&A. So kind of losing a lot of that um, growth story name. And then here we are going from nothing to, approaching 100 stores. You got another, significant pipeline. You've taken your business from 1 million to 100 million and no signs of slowing down. And also signing leases now into 26 and 27. So we have pretty predictable growth for the next 12, 18, 24 months. Well, that's what's changing. So yes, has the mix of investor calls changed? Yes, absolutely. And I think what happens too is over time, when people make money, you tell a friend, tell a cousin, tell a relative, buy some in a kid's account, all those things, right? So that happens. Conviction level on existing shareholders, some of them add more, and they tell friends. Institutions, though, are looking for growth. And Keir, you see this. You probably have a better lens even across other sectors than I do. But I'm hearing it daily. Like there's been some rotation out of some guys that made money in mining. There's guys that have made money in AI and stuff like that, and now they're looking to, a little more stable. Some stuff, a little more predictable growth. Some of them they call it like commercial and agri. Like when when it comes to food and agriculture, there's not a lot of names today doing what we're doing and delivering pretty consistent growth. I sat with an institution today, and he said, in small caps, he goes, when he looks across the sector, it's very few that he could name that are growing, have predictable growth of north of 20% a year, which seems to be at an institutional level a big magic number, 20% a year growth. Now, heck, if you're growing double digit quarter over quarter, they start to get pretty interested. I think last quarter we were up 26% for the quarter. So we're hitting a lot of screens because of our growth. The fact that we've been able to repeat it for an extended period of time, and we are certainly hitting radars of institutions. Now, yes, I get a lot of questions. You've seen recent trades go through for 1 million shares, 500,000 shares, that kind of stuff. Like, I can't really discuss that kind of stuff. That's not my place to say it. My goal is every day. I said this today. It's actually kind of funny because I don't think they really thought it was as funny as I did. My goal is to make this thing so good and such a great growth story and such predictable growth that institutions can't not hold it. Right? They have to hold at some point. Have to own it, or they're going to have to explain to their shareholders why they don't own it. So make the business so good, so durable, so strong that they have no choice but to own it. And I loved it. And they were like, well, you could be operating this privately. You could do this. You could do this. I said, yeah, I think if we took a company public today, I said, I think we could launch it almost at our current market cap, right from scratch. And I said, but how cool is that though, that early shareholders got to get in cheap, not cheap, but they got to participate before the institutions when we were 8, 10, 20 cents, 50 cents, a dollar. And then someday there's some of these shareholders are going to get to sell it to those institutions. That's why I love it. I think it's the way it should be done. That's my opinion.
Yes, that was something I identified pretty early on. I think I was the one that told you, well, you probably could have gone out with just your friends saying you're taking over a shell and probably got money and 100 million market cap to start. But I love the way you've done it.
Exactly. I get offered that all the time now, Keir.
Yeah.
Say, hey, do you want to start? You want to start a new one? We'll fund it. We'll put the market cap. We'll give you 1%, and you go. And my answer is no. Like I literally tied my name to this deal recently. Changed my own comp plan from, original goal was we got in was get the $2. and I say this very transparently, if you would ask me when we first started and we were 8, 10, 15 cents, and like, here I needed a mining helmet back then to see up, you know what I mean? It was hard. Uh, and, so we just put our head down and just, stuck to what we know, which is grind and build. Um, and I would have thought when I got to $2, I would have been on a beach somewhere. I would have been like, man, $2, I'm done. Like, I'm going to get off the treadmill and I'm going to go do like, just enjoy the $2. Whatever I made during that time, just go enjoy that time with my family and friends. Now, um, that's the definition of the saying, you don't know what you don't know. And here we are in a position where things have happened, right? The Fairfax piece happened with Recipe, the MTY things have happened. I believe this business is getting bigger and better than I ever dreamed it could be back when I was first starting. I'm having way more fun than I thought I was going to. Um, so the game has changed. And now I honestly believe whether I get it there or not, time will tell. But my personal ambition and personal goal is not just for me, but for everybody involved, everybody that's been part of it. And I just think it's like a cool as shit story. Like, why wouldn't you want to try and get it to $10? And I think it'd be unbelievable. And it'd be based on what's happened in the market. I think they're in the right place, at the right time. And I think now I'm trying to do something about it. The Ray Kroc line, like right place, right time, and do something about it.
So, because of the success that you've had, and we've seen some other restaurant groups sort of kind of struggle a little bit. We've seen what's been going on with Mighty, with MTY. They put
Yeah.
themselves up, strategic sort of review, probably looking to take it private or do something. Are you now starting to potentially see like larger potential brand opportunities or acquisitions where maybe they already have more units that are operational rather than having to take a chance on internally incubating a brand?
Yes. I've looked at deal sizes in the last 6, 12 months that have been up to 50 and 100 units. And probably, we would have never even got a peek at those before because people wouldn't have ever like assumed we could even transact. So they just wouldn't waste your time on calling you, right? Whether it's a banker running a process, it's a private investor. Some even called and said, hey, I have 50 stores, 100 stores. Would you join me as a partner? I need help. Right. So now so the different calls where before, this a few times before. We're getting started. We were trading at like 8, 10, 15 cents when I think you and I first had our first check here. It was like I was offering them Canadian Tire money. Right? So that nobody would take our stock. It was like I was insulting them, when I even mentioned it. I even had one guy yelled at me. And he's a nice guy. He's a shareholder now. And that's the funny part. But back then, before he was a shareholder and I tried to do an M&A deal with him, he literally got mad and yelled because I offered him stock. Now I offered him stock at 17 cents. So now, I do remind him of that every once in a while. So, um, but, you know, things are changing. The game is changing. What's not going to change is our discipline. And I literally had a meeting today and I tell guys the same thing. Great. I appreciate you guys. You consider us, you're in the process. But thanks to someone else I knew in the business that's a CEO that when he got his chance, he lost discipline and he overpaid and he blew up his M&A pipeline and he essentially blew up his company and his track record and his reputation in the industry just because he chased a bigger, shinier star, bigger deal. He overestimated his skill set of what he was capable of getting his arms around or how long his arms were. That's, like that overconfidence and whatever. We don't have that. I realize that, raise our debt ceiling, take on a deal that has huge operational risk and doesn't check the boxes where we believe we could double the EBITDA in 24 months or less, then don't touch it. Just walk away. Put your ego away. Stay true to your wallet. Take the emotion out of it and say, does it put my shares, anything I have, at risk? John DeLutis on our team the other day, and I'm telling you, this stuff makes me smile when I hear it or I see it happen. John's going through a process the other day, realizing now his income's tied to $10. And he literally said, Sean, I was going through this process on this thing I was working on. And I asked myself, does this help us or hurt us get us to $10? And I was like, oh man, I'm like a proud parent, you know what I mean? This smiling from ear to ear because internally the buy-in's there. So to make a mistake, if the risk profile doesn't fit, will we do a bigger deal? No. If the deal's right and there's a bigger deal to be done, and I believe that the risk profile fits, then we'll do it. But are we getting sniffs at them and peeks at them? Early looks at deals? Yes, we are. When I first was started this business, I was cold calling guys. And now, depending on the week, I can get from in a week 0, but some weeks I've had as high as 5 inbound calls a week for M&A. That's all market dynamics, us being more recognized. But I've had deals sent to me from UK, US, all across Canada, you name it. We've had M&A opportunities come our way now. And before, not one of those. Like nobody who knew even who we were. And I think
Question for
that,
you.
sorry,
Sorry, I'm just going to try to rattle off a few rapid fire ones because
far away.
running a little short on time myself. And we've kept the group here for quite a while. Will we see a U.S. listing in the future? Is that something you'd ever consider? Is it something that's on the roadmap, or starting to get anybody sort of asking questions,
Yeah,
looking
the
to meet you?
cadence. That's right. The cadence of people asking more and more about an uplisting is there. Believe it or not, it's not something that I get asked by institutions. Like 1 out of every 10 I talk to even mentions it. They're more focused on the business than they are the platform, than the trading platform. Which, if you asked me a year or two ago, I would have thought, well, that's going to unlock so many new investors and stuff. Will it? Some, yes, but a lot of the funds that want in first before those big, an ETF or something really big, they're able to play and trade and on all exchanges in Canada. So I tell you, it's more about the company and your fundamentals and your governance and how you operate than it is. The opportunity is much more important to them than the investment than the exchange. But would we like to, over time, at some point, be on the TSX or the Nasdaq? Yes, we would. I would love to. Why wouldn't we? If it's right, I think it was a mistake by one of the other food players at the time when they became more of their more of their revenue came from US than Canada, and they went and made a major acquisition in the United States. Well, they actually killed that ticker and kept their Canadian one. Well, I don't know. That would have been a heck of a time to be a very cash flow positive, dividend paying growth machine on the US exchange. I bet you their market cap would have went up dramatically.
I think I might know who you're talking about. Um, yes, I think it was probably a bit of a mistake in hindsight. Let's say you had 5 corporate stores that you could open today. What 5 would they be? Again, I'm just speaking hypothetically. You haven't said that you're going to open 4, but if you were going to open, open 5. If you were going to open 5, what brands would they be today? Would they all be heels, or would they be a combination? Which
They'd
ones would you do?
be, I would do, no, I do, because dollar wise, I would do um, 2 Rosies, 2 heels, and an IQ.
Sounds good.
Yeah.
Maybe upcoming catalysts. What are some catalysts that investors should shareholders like me, and that we should be sort of watching for? What sort of
Well,
how do you know that you're continuing to have success?
perfect. You know what? And I think that's a great one. Like, biggest thing we can do is open short term to give investors confidence of growth is the cadence of openings, right? Because and typically, if you open up, let's say 10 restaurants in Q1, which then you really only see 5 of them hit the fins. Those other 5, the whole 10, you don't really experience until the end of so for Q2. So that the continued compounding of net new units on a quarterly basis is what's going to drive the growth. So if you're looking for leading indicator, it's more locations signed, but just follow the openings. And so I believe because every one we open, that's on the franchise side is adding significant royalties to our business. So I think that's the number one indicator is that. And I think as we move into Q1 and Q2, like we've openly said, well, I've openly said like our record number was 12 for a quarter. And I'm hoping to beat that, I mean, in Q1 and Q2. So I think that would lead to meaningful growth on our fins. And then as we lap the back half of the year, if we had the back half of the year and we've already opened 20, 30, 40 restaurants, we're going to drive significant growth in the back half of the year in our financials. So that's what I'm looking for here, is just significant organic growth as our leading indicator per
So
catalyst.
I'm going to ask you a really uncomfortable question. You don't have to answer it. Should I buy more shares? Is now a good time? Do you think there's some good upside?
Well, if you didn't and your wife gets mad at you, then you can remember, it was your own fault. In the short term, we're trying to be $100 million business with 100 locations open minimum, and I have clear visibility into it. I have a good idea when that's going to start, and I'm going to tell you that's a very much a starting point for us, because I do believe an institution, from a catalyst standpoint, as big guys, they are looking for that $100 million revenue business, 100 restaurants open, debt free, cash flow positive. Those are the catalysts that the next, round of bigger investors is going to continue to come in at. And internally, we have, I think it's another $6 or $6.5 million is going to come in by June from, assuming everybody exercises their options. You're going to see that kind of money coming in from insiders. So we got a couple of the early institutions that got some warrants to exercise. So I do believe you're going to see warrant exercises. I do see you're going to see insiders buying more and increasing our share position. I think you're going to see us eclipse $100 million short-term run rate and start to return meaningful money to the bottom line. So, I can't predict where the share price goes short-term, but I can tell you where the business is going. Right. So I'm much more of a better predictor of the business than I am of the share price. But if I didn't tie my stay here for my current salary or anything and not get this higher than where it is today, like I just tied my entire income to $10 a share. So,
So we've touched on that a little bit. We danced around it, but why don't we sort of wrap up and have
yeah,
you explain a little bit about this comp plan? You've got some warrants
yep,
talking about insiders putting more money into the company next June, or this June coming up next year. That was based upon a vesting, based upon a share price that you had the right to be able to write a check to the company and exercise some warrants. You guys have recently done another sort of comp plan where you have another batch of, I guess, warrants that will vest based upon share price. Could you just give a bit of an overview on that for everybody?
yeah.
And yeah,
I would say when we did this first deal, I literally had been, watched a couple other microcaps do it. I thought management was brutal, how they, I'm going to say paid themselves before shareholders got paid. And I said, if I get into this and I'm going to put my name on a deal, I'd like to do it so that I only make money if shareholders make money.
are you still there? No, you're on mute again.
Yeah, sorry about that, guys. So I said, yeah, I only want to make money if shareholders make money. So I said, how do we do that? And so, we went above market. So we had to build it because we were trading at 10, 15 cents. We priced our first warrants at 20 cents. So the way it worked was there was 27 million warrants put out at the time, split up amongst the board members. And so to earn them all, we had 5 years to take it from 15 cents, 10 cents to at each level it unlocked. So there was an unlock at 20 cents, 50 cents, 75 cents, dollar 50, $2. We have till June of 26 to get this to $2 a share. Has to close that day at $2 a share. And to do that, that would unlock about 27 million performance warrants that we have the ability to buy at 20 cents a share. Now, Keir, I even got a call from another CEO asking me, saying, why would you do that? Why would you just give yourself a bunch of free options at the start and, go from there? And I said, yeah, but then I make money no matter what. Right. So I said, then that doesn't really fit, where I'm trying to do this and build trust and respect with retail shareholders. And so pricing it this way does two things. It aligns insiders with shareholders because if we over dilute or because other guys will just tie it to market cap. Well, they could issue 100 million shares and drive the market cap through the roof, and they get paid, but you just diluted the heck out of your shareholders. So it's a nasty game sometimes when you watch guys do it. And so what we did is we went out and said we're going to do this differently, and we're going to do this deal where everybody makes money, including shareholders, at the same time. All of our partners on the brands, if we did any JV deals, they got issued early stock. So they literally took a risk and traded some equity in their business for equity in Happy Belly. So we were aligned. So now they've hedged their bet. If they help Happy Belly grow, they win. You know what I mean? So everybody's aligned. Well, this time around, we said, okay, great. Now we're getting close to $2. A lot of people started asking, hey Sean, what are you gonna do after $2? If you hit $2, are you gonna leave? What are you gonna do? What are you gonna do? Is that the end? Is everybody leaving at $2? Like, are we closing the lights off? That's the end of the show. So basically, for those who I'm a huge fan of Yellowstone. I renewed. I renewed for about 5 more seasons, and said I'm going to stay here and see if we can build this $10 a share. And to do that, now the shares are priced at $2, and we were trading at $1.30, $1.40 when I agreed to that deal. Um, so still at 50% over market. And to unlock even the ability to buy them, we have to hit within 5 years. Some unlock at $3, $4, $5, $6, $7, $8, $9, $10. Now, if you get to $10, between myself and a few guys on the team, and majority of them go to me the way they're structured, we'd have to write a check for $60 million into treasury. So there's 30 million shares at $2 a share. So now we have 5 years to get to $10 a share. Might sound crazy, sure, but because when we were 8, 10 cents, and we said we are going to get it to $2, I know for sure everyone thought we were crazy. We were full of it back then. But here we are. We got till June, and we're 20 cents away. So we're going to grind hard to get this to $2, and then flip the script, put that money into treasury, use that money to accelerate growth by June, and then go chase the next level goal, which is $10 a share. So I believe if we have now going into June, let's say $5-10 million in treasury, we're cash flow positive, debt free, and we have secure debt and everything, and we have the ability to open hundreds more restaurants. And then down the road, potentially have another $60 million come into treasury. I think as a company, we're going to be, one of the better growth stories on the CSE for sure, and potentially in Canada for any small cap. Because of our structure, we're very capex light, so it doesn't require us a lot of money to go forward. Other than for M&A, we don't need a lot of cash. So I can tell you right across the board, from Rosie's, Pyro, Heel, any one of our partner brands, Yokes, doesn't matter. Everyone's aligned. We're all rowing the boat. We're all building the business based on three things: people, product, and process. I think the culture we're building, the teams we are, like, no, I'm being sincere. Like, I'm having so much fun. Like, this is unbelievable. It's like a chance of a lifetime for me to, just be part of something really cool. So I think that's the unique part. But yes, now everybody internally is focused on $10. As I said, John blew this a while ago. Does this help us or hurt us get us to $10? So that's pretty cool. I think so. You guys can know now. Like, and we did it publicly. We said, hey, we don't even get the chance to buy those if we don't get it there. So yes, it requires a little dilution to get it there, but it's a heck of a motivating factor from a management team to build it and only make money when shareholders make money.
Well, I think that's probably about it for me. I'm not sure how you guys want to sort of like wrap up, or if there's some other questions you might have. I'll kind of turn it back to the moderators here. And Sean, thank you very much for the time and 90 minutes of sort of back and forth there. I really enjoyed it. But let's see if there's any other questions or anybody or how they want to wrap up.
No problem. Yeah, if you want to do open mic, help yourself. Doesn't matter to me. But I appreciate your time too. Moneymaker, all the guys are putting it together. You know what? A lot of you guys are here OGs, and I thank you guys every day. You've been super supportive. So I try to be as transparent as possible. And help everybody do stuff in life that might not have been possible on their own.
Thanks, Sean. Yeah, we'll give it about a minute to see if anyone wants to come up and ask any questions. If not, we'll wrap up. So we'll give it about a minute here.
Okay. I can tell you though, after you come back from like seeing what we just witnessed this weekend, like minus 19 and people lined up in Calgary for smoothies and smoothie bowls, unbelievable. Like the reception from the brand when remember, that's not even the first store in the market. That's like store number 6 in Calgary. Then you look what we witnessed out in Halifax. Like it was chilly in Halifax, and it was lined up. People were so happy, even from midnight till 2, packed. You know what I mean? Like this is truly a blessing to be able to go across the country and see your brand and your team get accepted like this, like embraced by people. And very shortly, we're going to be operational from Vancouver Island out to PI. So, we are literally just getting started across the country.
Yeah, that's pretty crazy seeing that lineup at minus 19, especially when it's the sixth brand in that territory and not just the first one. It's pretty
Yeah,
impressive to say the least.
it is. It's a lot of fun. And, like if you see the team, you want to talk about, don't worry about me and some of that, but go with the team level. Go in there and see the people that work for Heel that are traveling and Jesse and then that built it. What their teams are achieving. You go watch Dustin, Daniel, Addy, Hamza, all the guys out there, like unbelievable. These people like Anna, it's unbelievable. You just get to see them like they're living their dreams, right? That saying, if you don't know, you don't know. 2, 3 years ago, if you go back and ask Dustin and Daniel, do you think you'd be at this position today? I guarantee you the answer is no. If they do, then man, they can predict the future. I'm going to get them to give me the winning lottery numbers that are coming because even I couldn't have predicted this. Now you're going to see them operate very shortly, the number one national, truly national smash burger brand in Canada. And very shortly, they're going to be the first one of any smash burger brands that I know of in Canada that's going to be open in the United States. And if that validates in the United States, I don't even know where it's going to go. I see shitty burger brands in the United States have 500 stores. Like terrible. You walk by and say, you want to go in there? No, I'm not eating that. But they have 500 stores. You Google them and you go, oh my God, these guys have 500 stores. Like there's a concept down there called Freddy's. They look at it and go, 500 stores. I never even heard of Freddy's.
Investing, you have a question?
Yeah, hello, Sean. So your process, people, product, and process. I was curious about the people aspect. How do you sort of detect people that you believe in? I see Dustin in the call, etc. How can
Hey,
you,
Dustin.
yeah,
You got to you got to meet them, get to know them. And it's a very interesting scenario. But, if you meet them and you don't think like, I don't want to say it the same way, but you don't want to, you're going to, I spend more time with these guys less time and I'm talking to them more and I do more stuff than I do with like your own wife or your own girlfriend or your own family. Right. So you have to get along. If you don't see that and share a common vision of passion and, respect, trust, all those things, and food, right? They have to be there. So the brands that I believe they're the most successful today in our portfolio, not because of me or Happy Belly, it's because of the team, like the team at the restaurant level. Like these guys are, what they're building is so cool. Like it's some of the best I've ever seen in my life, actually. So in my entire career, by far, like whether I've been part of the brand or not, when you look at who you aspire to be when you grow up, some of these guys are, they're crushing it. So you get to know the people. And if you don't like the people, don't worry about the product. You know what I mean? They got a great product. Yeah, but the people suck. Move on. Right. And I'll be the first one to say it. When I first met Dustin Daniels, just an example, not trying to throw you under the bus, and now you mentioned Dustin's on the call. I like this stuff, but I didn't love it. Then, but I met them and I was like, man, these guys are good guys, like passionate, they care. Met their dad, their team, the story about, the pudding, everything all there was all the makings of it were there. They made a few tweaks to the menu, a few tweaks to their marketing, a few little tweaks here and there, tweak, tweak, tweak. Now they have probably the hottest burger brand, in my opinion, probably in North America today. And it's that's cool, right? And that was them. They didn't make the changes. I didn't make the changes. It's all them, not me. Probably some, just a little bit of conversation, guidance, support. just confidence early too, because early on that that they didn't know. They're trying, but they don't always know, and that's why their sales have gone through the roof. And it doesn't matter where they open, there's a lineup. So people is number one, to your point. Then you can always work on the product, but it's much harder to change the people. So those brands are leading today, and they're opening more stores than all the other ones. Why? Because the people. Yeah. So they've got it in spades.
People over product almost.
Yeah, products secondary. The people secondary. Not even like it's not a close second either. I've had
Bill, you
lots
have
of
a
brands out
question?
there. You go to restaurants sometime, but the experience is amazing. Server's so nice, you go back, right? Service is amazing. Yeah, product is pretty good, but service was amazing. I find myself back there all the time. But if the service sucks, I mean, you're gonna think long and hard about going back.
Bill, you have
Thank
a
you.
question? You're on mute.
Like me earlier, trying to figure out the mute button.
I'll give it another minute here.
That's it. And Moneymaker finally, Heels opened in your neck of the woods. Obviously, you got two Rosies coming your way. You're finally going to get for yourself and your team. You're going to be able to burger shortly. Both the space at Grant McEwen, and then over at U of A, or they're in the works, right? So you're going to see them real shortly.
And the Yolks is in the near future, I believe.
Yes, yeah, Yokes, and then there's a bunch more. From Windermere to a bunch more Edmonton Heels on the way too. So. But Rosie's is going to finally start going to crack the code in Edmonton. And I was saying one of the biggest openings we had in the history of Mucho Burrito was actually in Edmonton. So I was talking to
Oh
Dustin
wow.
Daniel about it this weekend. So yeah, the one we opened up at Jasper and 109th,
Yeah.
that was one of the biggest ones in the history that I've ever opened. And yeah, so this could be really interesting to see how the guys do with the team in Edmonton. But that's on the way. UBC is on the way. Obviously, West Abbey's on the way. And we got a bunch more. Waterloo's going to be probably next up to open, and then it's going to be Myrtle Loop in Calgary. So the Rosie's guys in Q1 and Q2 literally are going to, they're going to test the elastic band and see how far they can stretch it in Q1 and Q2.
Question about when you opened up Mucho Burrito in comparison to a Joey Turks. How long did it take for Mucho Burrito to catch wind and start growing versus the Joey Turks? Like, are they both on the same path as one?
No, Mucho was a little bit ahead. Not much farther, but a
Okay.
little bit ahead. But it took
Okay.
about 2 years for Mucho to catch.
Okay.
Yeah, about 2 years, and then it took off. And the average unit volume of a Mucho over 2 years took off. And Dustin could tell you the same, but I think it was 2020 when they started, and the sales of a Rosie's when they started are a fraction of what they are today. It wasn't all Rosie's when they first started. Their sales, it was not. They had to grind it out. They don't think that those guys grew up with a silver spoon in their mouth and it just opened the first store and it was lineups around the building. Heck no. They got humbled, I think, day one, and they just as a team, Daniel and Dustin as brothers and family, they just built the business and they grinded it out. They did. And so
Well,
they're not it didn't just happen over. They're not yeah, they say an overnight success that was years in the making. That was Rosie's.
so when you say when it needs to catch on, what do you mean by that?
Just sales. Like it took time for customers to find you, and even social media 5 years ago wasn't what it is today, right? Food influencers and bloggers and stuff that didn't even exist back then. So it takes longer for people to find you, and then once they do, try it, and for word of mouth to spread, and so it takes a little longer. So it takes time. Sometimes it's tweaking the menu, tweaking the food, tweaking your marketing, and then sometimes it just clicks. So when you find one that clicks, hold on tight.
Got it.
Yeah. But yeah, those guys have earned every piece of it. Jesse at Heel, same thing. It didn't click like that in Hamilton when he first started. Heck no. he's grinding it out, like you know what I mean, and figuring it out, and it finally
Yeah.
clicked. Yeah, sales at probably their first stores, double or triple what it was when it first started. Today,
Wow.
yeah. So it takes time. And now
Incredible.
these guys have got it. So now they've got to, just don't crash the car, just like Happy Belly. Same thing. Now, when the cadence of store openings and things pick up, you need to, stay disciplined. Don't compromise on real estate. Don't compromise on the people you hire. Don't compromise on the product. Stay disciplined.
Awesome.
Yeah. So that's fun. So going into Q1, Q2, we will go into the biggest, back-to-back quarters in the history of the company for openings. And then you're going to go into peak season as well, right? Seasonality. So I expect the growth to be, quite significant in Q1 and Q2. And that's why I believe, probably based on recent performance, that Rob on the analyst side increased the price target.
Did he state how many openings in that price target? I didn't fully get a
I
chance
believe
to
he, I
read.
believe he increased it from 11 to 17.
Oh, I guess he took a second look at it after you said 11.
Yeah, that's right. So he increased it 50% for store openings in a quarter. Right. So that alone is material from a growth standpoint. There's a reason why he increased it.
Awesome.
Yeah. So that's coming into Q1 and Q2. That we expect a significant growth point for the company, inflection point. But Waterloo and Marda Loop for Rosie's are next up in early January, and for Heel, PI this week, and then Eaton Center the week after.
Awesome. And I
Yeah.
believe there's no more questions. No one's coming up, so I'll
All
leave the
right.
last
Well,
one
thank
to
you
you,
guys very
Sean, before we
much.
close off.
That's it. And other than that, next catalyst, other than openings, just financials coming out, and we just keep building the business. So I'll do my best to bore the shit out of you guys, and and just execute. Like nothing else for us to do. Just open more restaurants.
Well, looks like we got one person that raised their hand that's been having trouble coming up on stage. I don't know. But yeah, we will end it here. Oh,
Okay.
no, he
Thanks,
came up
guys.
and
You
he
got it.
finally got up. Let's see if
There
he
you go.
has a question. Philo, you're on mute.
Yeah. Giving the Quebec guy a chance to speak here.
Nope.
He's got to hit. Yeah, he's got to hit that mute button on his phone. Bottom left. It took me a while to find it too, right beside the camera.
And he cannot find it, so we will end it here.
All right, guys. No problem. Have a great night. Thank you, guys.
Thank you, Sean. Thank you for your time.
You too. Bye bye.
Appreciate you. Bye.